Hey, Archie, I'm seeing a ton of financial advice on the internet. Is it all good?
Well, Rob, if it's on the interwebs, it must be true. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, certified financial planning professionals Archie Hoxton and Rob Hoxton. And today we're going to react to some viral financial advice videos. We've done this in the past, and it's kind of fun, because people go out on the internet and give financial advice, kind of like what we do. I would say ours is more education.
Ours is good.
Yeah. But there's plenty of good stuff out there, and there's plenty of bad stuff out there. And then there's some stuff that's sort of safe and in the middle. We're
going to start with the bad stuff because it's so much fun.
Yeah, it's more fun. And I think we've reacted to a video from this gentleman before, and it was pretty bad. But so yeah, we can go ahead and just dive right in. If you spend enough time searching around YouTube and TikTok and places like that, you may have run into this person before, or several of these people. So
what's the worst financial decision you see 20, 30-year-olds make?
Not setting up a Roth IRA. You could be a millionaire from this. And it's incredibly easy. It's a retirement account. And by the time you're 65, all that profit you make within the account is tax-free. But the goal is that when you're young and doing that, you have 40 years of compound interest, where all of a sudden that $800 you invest could be worth $8,000.
This is weird because Stefan is a real estate guy. Why would he be promoting a Roth? You never have to pay taxes on real estate ever. It's called 1031 exchange and tax deferred refinances. You don't ever pay taxes. Why would he be doing this? I'm completely confused. I don't know why he's doing this. No, it doesn't make sense to try to get tax savings on top of something that already has a tax savings, because now you've gone from the effort of having two. But the problem now with your Roth is that when you withdraw, you have to pay a penalty on that. So even though you don't have tax, you still have to pay money every time you take money out of that. No.
Yeah. There's a lot.
The first guy, I think he was hitting it pretty right.
Yeah.
The one thing that he did say, which is a bit of a stretch, is that you could put $800 in a Roth IRA when you're 40 years from retirement, and that it would be worth $8,000 when you retire. You have to really pick some serious winners in order to get a 10 times type of return. But
yeah, and I like that guy. He's got really interesting, sound financial advice. That's part of why he's popular, and he actually gives realistic advice to just regular folks who are just trying to create a comfortable retirement.
So is he a real estate guy who sees the benefit of not having everything in real estate and instead having a little something in a Roth IRA that has securities? You can invest in real estate within a Roth if you have the right custodian, I suppose. But
right.
But maybe he's thinking a little bit of a couple of different things make sense.
Yeah. Well, he's a kind of an entrepreneur in general, and I think he's made money with real estate, but he also, my understanding of this guy is that he's interested in personal finance, and he's pretty clever. And entrepreneurial. And so he's not really, he doesn't exclude a whole category of financial good decision making just because real estate is, kind of his thing. The second guy, though.
Why would you want to have tax benefits on top of tax benefits? That sounds wonderful to me.
Yeah. The second guy lost me right out of the gate.
I don't think there's a single thing that he said that was correct, actually. I've listened to him and watched him a few times. I didn't find one single thing that he said to be correct.
I didn't either. He had some things that were true sprinkled in with statements that were false. But when it comes to something like taxes, some things, if you approach it with some truths and some falsehoods, it's going to be costly. The IRS is not forgiving when it comes to, you got to be right. And you can't expect that just because you do real estate, you're exempt from taxes.
Yeah,
That's
I mean,
just not true.
if you've ever done a 1031 exchange, which he refers to, that's a like kind exchange from one piece of real estate to another piece of real estate. There's a very narrow time window in which that transaction has to happen. And anybody that's been doing it for any period of time has probably run up against that deadline and maybe even missed it.
Yeah.
Right. So you've already sold one piece of property for a capital gain.
Right.
And you're trying to find a like kind investment in another property. So it has to be similar use. It has to have similar amounts of leverage. I mean, there are a lot of moving pieces here. If you don't get it done in time, you're paying taxes on that first sale.
Right.
So it's not a guarantee that you're going to be able to pull that off.
Right. Yeah. And he completely ignores the other ways that you can end up paying taxes in real estate. Capital gains aren't the only type of taxes that you pay in real estate. You pay property taxes, right? You pay taxes for owning a piece of real estate. If you have rental income, you may end up paying taxes on some rental income. So he's making comparisons between two very, very different types of investing.
They're not equivalent.
They're not even close.
If you do the Roth the right way, aside from funding it with after-tax dollars, you never pay taxes on it.
Right.
Right.
Now, he says something incorrect about that, though.
Mm-hmm.
He says, yeah, so you don't pay taxes, but you pay penalties when you take it out. But the key is...
You can pay penalties, but that's
Right.
voluntary.
Right. If you're using the Roth as it's intended, you're not going to pay penalties, right? There's the 5-year rule, and then there's the requirement to be age 59 and a half. You know, it is a retirement account, so it shouldn't be a surprise to anybody that you can't put it in, enjoy the tax-free growth, and take it out without any constraints. It's designed for retirement, and that's what gets it the nice tax-free status.
Since this guy got it so wrong, let's just really touch on some of the rules. So at any point in time, regardless of your age or how long you've held the account, you can pull your contributions out
Right.
of a Roth IRA. You have to leave your earnings, but you can pull what you put in out
Yeah.
without regard for your age or how long the account's been open.
Yeah.
If you want to be able to withdraw earnings, then there are a couple of things that have to come into play. Archie, you touched on it, the 5-year rule. The account has to have been opened
For 5 years.
for 5 years. There has to be a qualifying event. One would be that you have you turn 59 and a half.
Yep.
So you're 59 and a half or older. That counts as one. Another is that you're pulling money for up to $10,000 for a first-time home purchase.
Isn't that ironic that for real estate, you
Yeah.
can access it tax-free
Yeah.
early?
Yeah, that was not lost on me either.
Yeah.
And then if you pass away, then there are no penalties on earnings, regardless of your age, if it's being passed to a beneficiary. And then in the event of your permanent disability, you can pull money on that as well. There are also a few other penalty exemptions: qualified higher education expenses, medical expenses over 7.5% of adjusted gross income, health insurance premiums if you are unemployed. I didn't know that one, which was...
I didn't actually know that one either.
And then
That's good to know.
qualified birth or adoption, there's a limit of $5,000. So there are a myriad of ways that you can avoid paying taxes or penalties on a Roth IRA. You pretty much, so much so that it almost seems to me like a voluntary tax or penalty.
Especially because if you're under the age of 59 and a half and you've been contributing for a long time, more than likely a large chunk of your account is contributions in the first place, which, as we said, you can withdraw at any time without any penalty. It's the earnings that have the tax and the penalty attached if you take a withdrawal without hitting a qualifying event. So, more than likely you have some funds that you can access if you were to need them. And it's important to note that if you do take a withdrawal and you want to take contributions are considered to come out first. And there's a form that you can file when you do your taxes, or whoever does your taxes, to make sure that's clear. But yeah, I mean, the idea that these are inaccessible funds, that, the other thing that I think is important about this is the difference between what you own typically in a Roth IRA and what he's talking about with real estate. Roth IRA, while there are some relatively complex rules, the tool itself for building wealth is much simpler. It's more liquid. Going and doing every time you want to, whether it's buy a new piece of property or do a 1031 exchange, defer some taxes, it's extremely complicated and labor intensive. It takes a lot of time. Whereas, for some people, getting a Roth IRA, buying a target date fund and letting it compound over time is simple, it's easy, and doesn't take a whole lot of work.
That's a great point. I have had rental real estate before, and I've got a Roth IRA, so I've had both. My Roth IRA has never called me in the middle of the night because the toilet is stopped up.
Yeah.
I can guarantee you that it has never done that.
Yeah. That's a great point.
And it's not to say that investing in real estate isn't a great part of a broader wealth accumulation strategy, but
don't just be a real estate guy and ignore awesome tax saving opportunities that Roth IRAs present and other accounts present. Be more flexible in your mindset about your personal finance.
That's right. Hey, let's watch another video.
Yeah, I think we've got time for one more in here.
What is the best financial advice you've ever received?
Invest in assets, not liabilities.
What is the worst financial advice you've ever received?
The way to build wealth is saving your money.
So true. Third question. What is something you used to value that you don't anymore?
Material things.
What is something that you think people think is important when it comes to money, but you realize that's not really the right focus?
Net worth. Net worth is a crap indicator of real success.
Interesting.
Yeah, super interesting. He had me until the last one.
Yeah.
I mean, I think net worth is actually a pretty good way to measure progress.
Yeah. In financial success.
Yeah.
I think it kind of depends on how you're defining success. There's multiple ways to define that. Everybody kind of has their own, but net worth can be a pretty good indicator. Well, let's start back with the first one, the assets versus liabilities. This is something I think that was popularized by Robert Kiyosaki in the Rich Dad, Poor Dad book, where comparing assets and liabilities and the traditional definition of an asset versus the traditional definition of a liability, where assets produce cash flow, liabilities are an expense. So, for example, buying a house, many people don't consider that acquiring an asset. I would kind of disagree with that, but the whole point is good. It's assets build wealth, liabilities can detract from wealth.
You're right. And I kind of took it a little differently, Archie. I when he said that, I thought assets, liabilities, I thought stocks or equities and bonds.
Mm-hmm.
And because, bonds are, you're buying a debt instrument.
Right.
That's somebody's liability. When you're investing in stock, you've got equity in a business. So that applies as well. So have a bias toward assets rather than liabilities in that sense as well.
Right.
Yeah.
And if you want to think of it like that, it's better to have a liability that you own
as an asset
to someone else than to have a liability that is someone else's asset, like a bank. Absolutely.
Or a credit card company. Yeah. Yeah. So I liked his point about the best way to build wealth is through saving.
Mm-hmm.
Building wealth and having a secure retirement is not about, should I buy Bitcoin today?
Right.
Or should I be investing in quantum computing stocks today because I think everybody else says it's going to do well. It's about this slow, methodical, disciplined accumulation of assets through saving and investment over time.
Yeah. I think the key thing there is, to his point, we're not talking about saving into a bank account or a savings account. We're talking about investing. I mean, you need some cash for emergencies, but investing for the long haul, and investing in a way that's, prudent. Like you said, contributions are you're saving, you're making contributions. That's gonna do most of the legwork for most of the time that you're preparing for retirement, until towards the end when your investments start to really do the legwork.
That hockey stick.
Right. So I think that's really important. I think a couple other points, I think the point about material things, that, that he doesn't care about material things, and his point about net worth being a poor indicator of success. I think he's thinking of it in sort of the same vein, that having stuff and having a big a big balance sheet, high net worth, aren't the right indicator of success. I took that as, relationships, having really great relationships, having work that you enjoy, having freedom to do what you want, freedom to give, these sorts of things. That's how I took it.
The singular pursuit of money and wealth is something that will make you miserable. It's been demonstrated time and time again. It runs through all of the major religious teachings. That said, you got to have some money to put gas in the car, to buy eggs and bread and milk, to pay for your rent or pay your mortgage. So it's nice to not care about material things, but don't make that your number one thing.
Right.
But it's important.
Yeah, and I like to just make a distinction between financial success and just general life success, because you can have one and not the other. But if you have both, it just makes they work together more easily. It's easier to be happy if you don't have financial problems to prevent that. So anyway, we could probably talk about these videos for a long time. That's about all the time we have for today, but we hope you enjoyed it. Remember to like the video, leave us a comment, subscribe to the channel, share with your family and friends, and we'll hope to see you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.